Are you looking for a way to make $10,000 a month in passive income without breaking the bank? Well, you're in the right place. In this video, I'm going to show you how you can reach that impressive goal with just $50 a week. Yes, you heard that right. Just $50 a week. Whether you're just getting started with investing or you're a seasoned pro, this step-by-step guide will help you take your investment game to the next level. I'm going to break it all down. How small, consistent contributions, combined with the power of dividend and compound interest, can build you a portfolio that pays you $10,000 a month in passive income. And guess what? There's a special bonus waiting for you at the end of this video. I'll reveal how this exact strategy could actually lead you to building a $1 million portfolio that just keeps paying you month after month. So stick around for that. I promise you won't want to miss it. Chapter 1. The Power of Small Weekly Investments. Let's dive into how something as simple as $50 a week can pave the way to financial freedom. Now, I get it. $50 might not seem like a game changer at first glance. Maybe it's what you'd spend on a casual dinner or a few coffees. But here's the secret. When you invest that $50 regularly, it becomes a powerful engine for growth. Think about it like this. $50 a week adds up quickly. That's $200 a month, or $2,400 a year. But the real magic happens when you start investing that money consistently. Each week, you're not just setting aside cash, you're putting your money to work. And with the power of compound growth, that investment keeps multiplying. The key here is repetition and patience. By investing the same amount every single week, you tap into the strength of long-term growth. It's not just about watching your money sit. It's about letting it compound, grow, and generate even more through dividends. And when you reinvest those dividends, the snowball effect kicks in, creating more income with each cycle. So while $50 might seem small now, over time, that steady contribution can grow into something significant. This is the foundation of turning your investment into $10,000 a month in passive income. Consistency is key, and it's that simple. Chapter 2. DRIP, or the Dividend Reinvestment Plan. Alright, now let's talk about the real engine behind your investment growth. DRIP, which stands for Dividend Reinvestment Plan. It might sound complex, but it's actually pretty straightforward and incredibly powerful. Let me break it down for you. Here's the idea. When you invest in dividend-paying stocks, those companies pay you dividends regularly, usually every quarter. Most people might take those dividends as cash, maybe spend them or save them. But with DRIP, instead of taking that money out, you automatically reinvest those dividends back into buying more shares of the same stock. And that's where the magic happens. The beauty of DRIP is that every time you reinvest, you're increasing the number of shares you own. So now, those extra shares start earning dividends too, which you'll reinvest again, leading to even more shares, and the cycle continues. It's like building a snowball. Each reinvestment makes the snowball, or in this case, your portfolio, bigger and bigger. The key benefit here is compounding. Over time, as you reinvest your dividends, your investment starts to grow at a faster pace. Even small dividends reinvested consistently can lead to exponential growth in the long run. This means that what started as a modest investment begins to multiply itself through compounding returns, without you having to do anything extra. Another great thing about DRIP is that it takes the emotion out of investing. You're not worried about timing the market or when to buy more shares. The plan automatically reinvests your dividends regularly, regardless of what the market is doing. This helps you stay disciplined and focused on your long-term goal. So while DRIP might seem like a small tweak to how you invest, it's actually one of the most effective strategies for long-term wealth building. By reinvesting those dividends automatically, you set yourself up for continuous growth, which is exactly what we're aiming for with our goal of $10,000 a month in passive income. Chapter 3. How to reach $10,000 a month with DRIP. Now let's get into the numbers. How exactly do you go from $50 a week to earning $10,000 a month in passive income through dividends? This is where the strategy comes to life. And I promise, the math might surprise you. So let's start with the basics. You're investing $50 every week. That's $200 a month, or $2,400 a year. Now, when you invest this money into dividend-paying stocks and use DRIP, you're not just making a one-time investment. You're continuously growing your share count, and each of those shares is earning dividends. Over time, this adds up fast, thanks to the power of compounding we talked about earlier. Let's assume you've built a diversified portfolio of dividend-paying stocks with an average annual dividend yield of around 4%. That means for every $100 you invest, you're earning $4 in dividends each year. But here's where it gets interesting. Instead of spending those dividends, you reinvest them through DRIP, which means you're buying more shares. Those additional shares then generate more dividends, and the cycle repeats. Now, fast forward 20 to 30 years. With consistent weekly contributions and reinvested dividends, your portfolio continues to grow not just in size, but also in the amount of passive income it generates. By the time your portfolio reaches a substantial size, let's say around $2 to $3 million, that 4% annual dividend yield could easily generate $10,000 a month in income. It's important to remember that this strategy takes time. We're talking about consistent investing over decades. But the good news is, once you've set this plan in motion, it works almost automatically. Your portfolio grows, your dividends grow, and one day, you wake up to find your investments are paying you $10,000 a month in passive income. So while it might start small, the compounding effect turns it into something massive. Stick with the plan, and the numbers will take care of the rest. Chapter 4. Choosing the right stocks. Now that we understand how DRIP works and how your investments can snowball over time, let's talk about a crucial piece of the puzzle. Choosing the right stocks. Not all dividend-paying stocks are created equal, so it's important to be strategic about where you're putting your money. When selecting stocks for a long-term dividend reinvestment plan, you want to focus on companies that have a strong history of paying and growing their dividends. These are typically companies with solid financials, consistent earnings, and a commitment to rewarding shareholders. One of the best places to start is what we call blue-chip dividend stocks. These are well-established, financially stable companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble. They have a proven track record of delivering steady dividends, making them a reliable foundation for your portfolio. But we don't stop there. Another group to consider is dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. Think of companies like Walmart or AT&T. They've shown a strong commitment to their shareholders, which makes them a great choice for consistent, long-term growth. Now, if you're looking to boost your dividend income more aggressively, you might want to explore high-yield dividend stocks. These companies offer higher than average dividend yields, which means more income upfront. However, they tend to carry more risk, so balancing these with more stable stocks is key. Real estate investment trusts, or REITs, and utility companies often fall into this category. Lastly, don't forget about growth-oriented dividend stocks. These are companies with strong growth potential that also pay dividends. Think tech giants like Apple or Microsoft. These stocks give you the benefit of both capital appreciation and growing dividends, making them perfect for long-term growth. The bottom line is this: by choosing a mix of reliable blue chips, stable dividend aristocrats, some higher yield options, and growth-oriented stocks, you can build a diversified portfolio that not only generates steady income, but also grows over time. The right stocks are the fuel that will power your journey to $10,000 a month in dividends. Chapter 5. Building a portfolio worth over $1 million. Now let's take a step back and look at the bigger picture. What could your portfolio look like 20, 30, or even 40 years down the line if you stick with this strategy? It's exciting to think about, because with consistency, time, and the power of compound growth, your portfolio has the potential to grow into a 7-figure powerhouse. Let's do some quick projections. If you're investing $50 every week and reinvesting all of your dividends through DRIP, your portfolio is not just growing from your contributions, but from the compounding effect as well. Over a couple of decades, This steady compounding can lead to a portfolio worth over $1 million. And the best part? It's working quietly in the background, growing while you go about your daily life. A portfolio of that size, say $2 to $3 million, could easily generate $80,000 to $120,000 a year in dividends, depending on your yield. That's $10,000 a month in passive income. Imagine waking up one day and realizing your investments are paying you a full salary without lifting a finger. This is the power of long-term investing. It's not about getting rich quick. It's about building sustainable wealth over time. And by sticking to this plan, you're well on your way to turning $50 a week into $1 million portfolio that works for you. And there you have it, the path to turning just $50 a week into $10,000 a month in passive income. If you found this video helpful and you're ready to start building your financial future, make sure to give this video a thumbs up. And don't forget to subscribe to the channel for more strategies on investing, personal finance, and achieving financial freedom. Thanks for watching, and I'll see you in the next one.